And I'm so pleased to have the honor to introduce our next speaker, Dante Disparte. I know all of you are familiar with Dante. If you're familiar with this space, Dante is the Chief Strategy Officer at Circle, as well as the Head of Global Policy. Dante's everywhere, researching, publishing, serving on boards, really advocating and educating people on this topic. Closer to our NYU heart, Dante is also an alum of our MS in Risk Management program. And what a role model, going out there and taking his education, applying it to the real world, really managing risk in a very uncertain, crazy environment. So I'm just pleased to introduce you, welcome you back to your alma mater, back to your old stomping grounds, and please join me in welcoming Dante.
Thank you, Professor Shahata, Professor Berner, and NYU Stern for allowing me to make a triumphant return. Who knew a conference about governance, accounting, and regulation could be so much fun? That last panel was awesome. I was on a Senate hearing in the Senate Banking Committee, and Professor Allen was one of the other witnesses, and you just cannot but have deep appreciation for the countervailing views. I think it's really important that those surface, and I'm glad that that was brought to the NYU campus. So I prepared remarks. This is not ordinary for me to have prepared remarks, but I figured if I'm going to come back to NYU and make a triumphant return, I need to leave a good impression. So thank you, Professor Shahata, Professor Berner, for giving me the occasion to make a triumphant return to my alma mater. Here in the venerable halls of the NYU Stern School of Business, as I earned a master's degree in risk management, I learned that you cannot buy insurance when your house is on fire. Crypto's house was on fire in 2022. And the fire brigade was the blend of responsible regulated actors, good governance, regulation, and accounting. In short, 2022 was a system-wide stress test. And as the Bank of England's John Cunliffe has said, the companies that survive this particularly dark and frosty crypto winter may very well be the Amazons of the future. Circle is a leading regulated digital financial services firm and the issuer of a dollar digital currency known as USDC. Over the course of USDC's 5 years in circulation, we have not only demonstrated the art of the possible with programmable and composable digital currencies, we have connected the dots between the analog and traditional financial system and an always-on internet of value. That internet of value is still in its dial-up phase, but progressing rapidly according to Moore's law and advancing courtesy of the time, talent, and treasure of millions of developers around the world towards broadband, high speeds, and operating resilience. Indeed, it is not long before the use of constantly upgradable infrastructure, AKA public blockchains, approximates Visa-scale transaction throughput with settlement finality in microseconds and the global reach of the internet. Indeed, already today, USDC-enabled digital wallets are active in more than 190 countries, creating an era of internet money for Thomas Friedman's hot, flat, and crowded world. We should take great heed with the increasingly loud calls to let crypto burn or to relegate it to a form of internet gaming, like trading JPEGs rather than real value. This would be the equivalent of halting the development of the internet because of the frustrations and slow pace of the worldwide wait phase of the dial-up era and the lascivious and criminal nature of the dark web. With more than 43 billion of USDC in circulation, which has cumulatively processed over 9 trillion in transactions, we have learned a thing or two about trust, transparency, disclosure, and accountability over Circle's 10-year history. Indeed, as the dollar faces its own digitize or die moment, as some argue the US is pitted in a fierce digital currency space race with adversarial countries and companies, our experience with USDC tells a powerful counter-narrative that the US is in fact in the lead and the dollar is the currency of the internet as much as it is the reserve currency of the world. While the physical US dollar is emblazoned with the words "in God we trust," well-regulated and trusted digital dollars would say "in code we trust." Yet, as we learned in 2022, Perhaps in code we trust is not enough. Borrowing from our friends in the cyber resilience domain, we also need defense in depth when it comes to trust, transparency, and accountability in fast-moving, fast-evolving digital finance. Ironically, by today's regulatory and compliance standards, if you proposed an innovation, a financial innovation called Catch, it would likely not be approved for its opacity, limited transmissibility, and for being a vector for spreading disease and financial crime. During the onset of the COVID-19 pandemic, some countries even resorted to laundering their physical money or imploring the public to put more of it in circulation, as we did here in the United States. Last year, we learned some painful lessons in the digital assets industry. And hopefully along the way, those who care about consumer protection, modernizing regulation, as well as promoting responsible innovation in financial services will be spurred to action. Chief among those lessons is that promissory statements on Twitter do not make durable business models, let alone durable competition to often stranded financial services that are stuck in the 1700s. We have to remember the original thesis with the advent of digital currencies and Bitcoin 14 years ago was that it was supposed to be a correction to many of the misdeeds, the greed, and the fear of missing out that was the tinderbox giving rise to the 2008 global financial crisis. And while a $2 trillion haircut in the digital assets economy does not kill a novel sector, especially not when most of the failures have human causes, not technological ones, it is nonetheless a hefty down payment on both demonstrable real-world value and trust. It is also a reminder that, like banking, crypto is not monolithic. This is not in my comments, but imagine taking all of banking and indicting it because of the $250 billion money running racket of Danske Bank into Russia. So we're doing the same thing today with the digital assets economy. How many crypto and digital assets projects, particularly stablecoins, would withstand the ultimate test, what I call the Jerry Maguire test? Show me the money. As the accounting professionals and professors in the room will tell you, it is not merely enough to show someone the money. You must also account for it. Last year, the beginning of the end of the speculative phase in crypto was triggered by an interesting cast of characters and key events, many of which we've already discussed, proving yet again that technology did not fail, people did. For example, the stable in name only digital derivative, Terra Luna, whose braggadocious frontman, Do Kwon, made light of billions in excess financial risk and losses, including playing a game of catch me if you can on Twitter with Interpol. He probably would have shown up to this conference had you invited him. Demonstrating the limitations of trust without verifying. In my fair city of Washington, D.C., the baseball stadium carried Terra Luna's name on all the seats and emblazoned throughout the arena. Just the same as there was a stadium in Miami carrying the scarlet letters FTX. Both monuments to unchecked financial alchemy, fear of missing out, and perhaps fraud. However, it begs the question, was this a failure of underwriting and a lack of regulation? Or was this a failure of people succumbing to paycheck persuasion and believing that everything that glitters is digital gold? The difference between risk in crypto versus traditional finance, perhaps driven by the speed of information sharing in digital assets and the proverbial digital breadcrumbs they leave behind, which has given rise to a cutting-edge crypto forensics industry, is its discoverability. Terra Luna's $60 billion collapse occurred over a weekend, just as the pyramidal structure of FTX was toppled with a tweet. Meanwhile, as much as I hate false equivalencies, Bernie Madoff made off with billions in an undiscovered Ponzi scheme lasting decades. Very hard to repeat in this space. The discoverability of risk, illicit activity, and ne'er-do-wells in the crypto economy is a powerful feature, not a bug. Anyone armed with a magic internet looking glass is a part of the collective tripwire system, with the boundaries of internet privacy being an emerging challenge. If I were alone in a room with one of you and gave you a $20 bill, aside from raising eyebrows and questions, accounting for the transaction would be my word against yours. Since you are all accounting geniuses, you would likely prevail in a double spend scenario or in a dispute. Now, by contrast, if I gave Professor Shihata $20 bills on stage in front of this live audience and the hundreds watching on the internet, dispute and transaction resolution is validated by collective witness. This feature of blockchain-based financial services works with profound societal and market implications. It has not, however, made auditors and accountancy relevant. Rather, it has given them another layer of reasonable assurance on which we can irrigate the wellspring of societal trust, which, as Edelman has reported over the last 20 years with their trust barometer, runneth dry. Herein, 2022 in the digital assets market was a hybrid between the dot-com bubble and the greed-fueled excesses of Wall Street in the lead up to the 2008 financial crisis. Perhaps crypto's Dodd-Frank moment will follow as regulators and policymakers seem poised to end their wait-and-see observation period, finally laying out a level playing field for responsible development of digital financial services. This is not only a matter of national security and competitiveness, it is a matter of extending beyond the physical limitations of brick and mortar banking and analog payment rails, which have reached a point of diminishing returns as COVID-19 has shown us. For example, in the US, the mobilization of more than $6.6 trillion in government to citizen payments and other forms of pandemic relief. Other forms of pandemic relief. There I am. The void of trusted, real-time, auditable, and corruption-resistant payment systems may have contributed to the loss of $75 to $400 billion due to mysterious disappearances in the banking and payment system. Tragically, the pandemic has also exacted the highest cost on those who could least afford it, including reducing the flow of typically recession-resistant remittances by more than $200 billion. Trust is the real currency in financial services, if they are to be utilized every day in a durable manner. This trust holds true for analog banking and financial services, as it does for their digital twins. Blockchain is often referred to as the trust engine, the trust machine. I once wrote that blockchains record trust like an atomic clock records time. It is inexorable and irrevocable. But is this trust broken? And is the word crypto, short for cryptography, now vulgar and untouchable? Or, like all forms of novel emerging technologies, are the real stewards of its utility value those with steadier hands and regulation-first approaches? For example, in the stablecoin segment, for which we generally reject the term as a catch-all that dangerously lumps together responsible digital currencies and their stable and name-only namesakes, there are a few key pillars of trust that matter. For example, turning back to the Jerry Maguire test, show me the money. At Circle, we have opted for a race to the top on transparency, trust, disclosure, and accountability. That alone, however, is not enough. We have also implemented an asset liability management model on par or better than the world's global systemic banks, all without the perilous fractionalization or rehypothecation that necessitates a public backstop in the form of the FDIC insurance, bailouts, resulting in the privatization of gain and socialization and trillions in losses. Some very large stablecoin issuers are still failing the test, and in many cases are relying on the same troublesome blend of promissory statements on Twitter and half-hearted attempts at transparency and accountability. Sunlight is the greatest disinfectant, and while we should all be encouraged, the crypto projects are embracing transparency and accountability. Circle and USDC were born in it. For example, many stablecoin projects have failed by ignoring the pre-existence of money transmission, electronic stored value, or e-money regulations around the world. These rules do not only require national licensing, annual examinations, and basic conformity with operating requirements, including financial integrity norms on combating illicit finance. They also include fiduciary standards that protect and preserve customer funds, including by preventing the type of financial alchemy we saw with Terra Luna. Indeed, while state money transmission rules in the US present a national mosaic of fintech regulation and opportunity, amounting to the proverbial financial laboratories in our country, they're not giving rise to the era of internet funny money or wildcat banking, contrary to some views. Unlike Europe's e-money frameworks, which saw the collapse of Wirecard due to opacity and other risks, large US money transmitters and payments companies have not faltered under the watchful eye of state banking regulators. Thus, the US competitiveness gap is not domestic, It is in expressing, exporting, and harmonizing these standards for digital dollars around the world. Trust is the sum of the parts, just like governance, regulation, and accounting. Trust compounds, accrues, like national or corporate value systems. It matters most in periods of duress and stress. The verified part of trust but verified is where the audit and accounting profession steps in to provide added layers of assurance, independence, and oversight. While there have been some definitional debates about the difference between an audit, which is typically carried out on an annual basis for firms or activities that are designed to be audited and are not afraid of disclosure or accountability, and attestations, which are designed to provide routine and ongoing assurances on specifically reviewed items. For example, ever since the first USDC entered into circulation, Circle has issued third-party attestations from leading global auditing firms about the sufficiency of USDC's dollar-denominated reserves to meet all demands for USDC in circulation. From the first dollar to 43 billion today, this process has evolved every month down to daily reporting of US Treasury QSIP numbers, like the second hand on the clock, and has exceeded the transparency, accountability, and disclosure of comparably regulated household names in global payments. We do this so that you do not have to take our word for it, nor our tweets. And to solve the buyers and spenders remorse that has plagued crypto over its maiden decade. I'm grateful to Professor Shihata, Berner, and NYU Stern for the occasion, and to all of you for your attention. Thanks again. Sure. And there's only one, and if okay, only one. Go ahead.
Well, Dante, I thought you were going to continue with Jerry McGuire and say you complete us with Circle or something like that. Thought that was coming. But the question is, in all seriousness, you travel boots on the ground around the world, advocate the industry, kind of what's coming. What's missing from the So the question really is, you're boots on the ground. You're all over the world speaking on behalf of the Circle, the industry, some of these concepts. What's missing in the conversation here in the States versus what you hear elsewhere?
Yeah, that's a great question. And he's not planted, although I will airdrop some USDC for you. Well, look, let me be very honest. When was the last time you went to an internet conference or conversation and you spoke about hardware and software? I think the point to say that you echoed up on the stage earlier, that it is early, is that when the technology is still a protagonist, you're not anywhere close to the types of outcomes that people, markets, and consumers want. And so I think that's missing. The other piece that's missing is the United States is alone in the world in not having a federal payment systems charter. Libra set itself up in Switzerland, not because of regulatory arbitrage. I know, I brought the damn thing to life. We set ourselves up in Switzerland because the Swiss financial markets regulator, FINMA, has a financial markets infrastructure or payment systems charter. And here we are staring at both risk and opportunity doing nothing. And so I think the issue we have in the country is a fintech constitutional crisis. I have licenses in every state like PayPal does, but we're still having a conversation where technology is a protagonist. And I think that's the gap. And so hopefully today's conference and this event will make the tech go to the background. Thank you.